Hello and welcome. In today's video, I'm analyzing Tata Elxsi. The company is basically providing product design and engineering services to the consumer electronics, communications, and transportation industries, and systems integration and support services for enterprise customers. It also provides digital content creation. I'm going to analyze this company with its peer group company. One of them is Persistence and the other one is 8K mile services. The reason for taking up 8K miles in this is to understand how not to get stuck into bad companies and how to stay with a good company, what kind of ratios we should look for. And even if we are invested in a company whose fundamentals are getting bad, we how to get out of it by checking out core ratios. So let us begin by looking at the market cap. Currently, the company is valued at 9,731 crores. Today's date is 25th November 2020. 3 years back it was 4,563 and 5 years back it is around 3,605 rupees, 5 crores. So the market cap has increased over the years and that is a good sign. We want our company's market cap to grow. As the market cap grows, that itself includes the price. The price is also growing along with it. The current price is 1,563. Its highest it had reached in the last 1 year was 1,710 rupees and the lowest was 500 rupees. So this is quite near to its 52-week highest point. The current price earning is around 31 times, expensive, but we'll need to check out its 5 years or average PE or median PE and then buy around that price earning. Book value is 182 and the current price is 1,563, trading at an extremely high premium to its book value. Almost, I think, more than 8 or 9 times. Dividend yield is 1% on the current price. Return on capital employed is 35%, very good returns, and that is why it is also trading at a high premium to its net worth. Return on equity also latest is around 25.6%. This ROCE ROE excludes or includes exceptional item depending on whether it's an income or loss. Face value, no dilution at 10 rupees, that's a good thing. Book value 3 years back was 119 rupees and now it has increased to 182. So the company has managed to grow overall in terms of its net worth. There are 6.23 crore equity shares outstanding in the market. Operating profit margin from last 5 years is around 23.7% generated. So this is a very good returns on the top line revenue. Return over 1 year is 96%. If you had bought 1 year back, you would have almost doubled your money here. Over 3 years, it has been compounding at the rate of 18% every year. And over the last 5 years at 9.7% compounded. So although the returns are not that good over last 5 years, but over last 3 years it has given 18% compounded. Debt is 54 crores. So on overall on the total market cap, or rather net worth of, we'll see it later on, debt to equity, but this 54 crores on the total market cap looks quite nominal or very small. There was no debt in the preceding year. Even 3 years back there was no debt. So the company is almost debt free. That is what it means here. And now it has increased, but by 54 crores, which is a very small value. And even if you look at the interest cost, that too is very low on this debt. It's just hardly 10% or so, 5.57 crores in the recent 12 months. Company's debtor days or collection days has gone up from 72 days to 89. So company is giving more credit to its customers. It should not exceed 90. 90 is my benchmark. That is not more than 3 months should be exceeded to collect payment from the customers. There are no investments. Cash holding is around 739 crores, which is a very high value. We'll need to check out and compare this with the total balance sheet size. The total balance sheet size is 1,428 crores. So almost 50% of that is in cash holding. Generally, I don't like company holding too much of cash, and that should be transferred into investment activity rather than holding on to the cash, as it generates very less returns. Trade receivables 359 crores, again a very high value. This needs to be checked why the company, as we earlier saw, the collection days have also gone up to 89, and the trade receivables are also quite substantial, 359 crores against the total balance sheet size of 1428 crores. So that is almost around 30% or so. That we'll check it out when we do the peer group comparison. Trade payables are just 42 crores, so it is paying regularly to its suppliers. It doesn't have any dues towards its suppliers, but it has to collect a substantial portion from its customers, and if these customers don't pay, the bad debt increases. If you don't understand any of these ratios, you can check out my older videos, which are detailed videos of more than 1 hour each, and there I've explained at my own pace what each of these ratios mean and how to understand them. Working capital is positive 1031 crores, so there is no asset liability mismatch. That is, their current assets are enough to pay off this year's liabilities. You can also get in touch with me if you want to learn from me directly on a one-to-one basis through the internet or through Zoom meeting. You can send me an email and then we can take it up from there. You'll also find the link in the description of my email account. Net block or net assets is 141 crores, and 3 years back it was 108 crores. So the assets have increased by almost 50% from where it was 3 years back. The current debt is hardly anything, as we earlier saw. It can be easily paid off using the current year's profit. It's just 20% of the profit. The current market capitalization or the price is around 5.75 times higher than the revenue it has generated. So this is also quite high valuation wise. We can buy somewhere around 3 or 4 times. That would be a good valuation according to me. The profit after tax of last 5 years total is around 1118 crores. So against the total balance sheet size of 1428 crores, the profit generated over 5 years is very less, or almost 1/4, or rather equal, it's almost equal to the balance sheet size. So it's a good thing that the company is generating profits. So this way we can compare the profits against the total balance sheet size. Against this profit of the last 5 years, the cash earning capacity is 934 crores. So it is converting most of this profits into cash also. Company also has a substantial amount of free cash flow left with it. Mostly this should be utilized to pay off either dividend or do buyback, bonus, etc. Moving on, let us look at how the price has moved over the years. As of today, 24th November, the price is 1562 rupees per share, and its 200-day simple moving average is at around 1030. So this could be taken as a base price to buy into it. Most probably we should not buy so high. Let it come down, and at that time, if the fundamentals are good, right now we can just do the revision and see which are the good companies that we want to buy into, and keep a list of them, so that as and when there is a fall in the market, at that time we will be ready to buy into these companies. So till that time we can study and understand which are good companies to keep in our portfolio, but not at this expensive valuations. So let it come down a bit and then we can buy into this. So currently we can go for around 1030 rupees or something around that as of today, based on a 200-day simple moving average. Around 5 years back the rate was around 980. So from there, if we consider to where it is currently at 1560, so it has almost given, as we earlier saw, a compounded return of around 96% in last 1 year, and from 3 years back around 18% compounded, and from 5 years back around 9.7% compounded. So these are good returns in a way, not that exceptional, but a good generation. If we look at the current price earning, it is around 31, and on an average over the last 5 years it has been trading at around 27.2 times. So this is a good price point to consider buying into the company at 27.2, or rather 27 times the earnings. That will be a good average, long term average of the 5 years. And if you look at the long term average of the last 3 years, the median PE stands at around 22. So we can target around 27 and 22 based on 5 and 3 years average median price earning. So that would be a good time to buy into the company. Till that time, we have to wait patiently. Here in this chart, we can see that the company's revenues over the different quarters have been increasing in an upward trend, so which is a very good sign, which means that the company is having business and is increasing its business as well. The OPM margin and the NPM margin in the latest September quarter was around 27 and 18% respectively, with a 430 crores of quarterly sales, which is on an average quite good, considering that its revenues have also been increasing on an upward trend. Let us look at the positive and the negative points. The company is debt free, which we have already seen. The returns on equity is quite high over the last 3 years of almost 31%. And company has a very healthy dividend payout policy of around 32.5%. So almost 32% of its profits is paying off. As we earlier saw also, that company has huge amount of cash. So generally it would pay off that cash to the shareholders. Stock is trading at 8.58 times its book value. This is quite high. So we'll need to look at its long-term average book value and then consider where we want to buy into this company. So in the peer group analysis, I'm comparing Tata Elxsi with Persistent Systems and 8K Miles Software. As I mentioned, the reason for taking up 8K Miles Software is also to understand what kind of red flags would be apparent for us to not invest in a company, and how we should stay away from such companies also. The current price of Tata is 1562, Persistent is 1213 rupees, and 8K Miles is around 85 rupees. Tata Elxsi is very much nearing its 52-week high. The fall is around 8.6% from its highest point, 12% for Persistent and 23% for 8K Miles. The results for all three companies is up to date quarterly up till September 2020 and March 2020 for annual results. Starting with the sales figure of the previous quarter, 385 crores for Tata Elxsi and 430 crores in the recent quarter. So that's an 11% gain in terms of revenue. This is very crucial to see that company is managing to grow its revenues as well as cash. So Persistent System also has gained around 13% in its revenues, but 8K Miles has seen 18% fall in its overall revenues from 808 crores in September 2019 to around 89 crores in September 2020. In terms of profits, Elxsi has gained around 58%, Persistent has gained 18%, whereas 8K Miles has seen around 71% drop in its profits from 11 crores to around 3.15 crores. So we see a very high pressure on the margins of the company. If we compare 1 year sales figure with the recent 12 months, Elxsi has almost given this, the overall value of sales hasn't changed from 1600 crores marginally to 1693 crores, whereas profit has gained from 260 crores to 305 crores. So this has, although the sales has not gone up, but the profits have gone up. Persistent System also has seen a growth in its profits from 329 to 363, and the sales also has gone up, or revenue generation has gone up from 3565 crores to 3848 crores. In the recent 12 months, 8K Mile has seen a drop in its recent revenue generation from 382 crores to 358 crores, whereas profits have come back into positive in the recent 12 months from a loss in March 2020 of 52 crores to 7.16 crores, whereas cash generation is still there of 86 crores positive, but overall in terms of P&L account it has shown a loss. So we want both of them to be positive and nearby to each other. Let us look at Tata Elxsi first. It's 256 crores of cash generated against profits of 260 crores. So almost very nearby to each other. This shows that whatever profits the company is generating is being converted into cash. Persistent system also has generated almost equivalent cash as shown in the P&L account. On an average, last 5 and 3 years, the price earning has been around 25 and 20, whereas current price earning is 31. So we can take this as the base values of price earning to time our entry into this. But I use technical charts to buy and sell stocks. I generally don't use fundamental valuations. I do check out fundamentals just to understand if I want to buy this company or not. Once I determine if I want to buy, then based on technicals I do the analysis and buy into the company. If you want to learn from me, you can contact me on my email address. Persistent system also has gone up quite a bit to 25 times, where it was on an average trading at 17 and 14 times. 8K miles price earning is extremely high at 36 times, and also if you see way too above its averages. In terms of price to cash, Tata Elxsi is again expensive at 37 times, persistent system also expensive at around 28 times, and 8K miles at around 3 times. But we see that last year in March 2020 it made a loss, although in the recent 12 months it has come back into positive. But we have to check out and wait if this also turns back into negative. Price to book very expensive for 8K against the total equity, because they had to write off a lot of their assets, and because of that the debt to equity, the price to book has turned, or market cap to book value has turned adverse for them at around 10.4 times. So it's become very expensive right now based on the book value. It does not mean that this is a good company, it's just that the overall equity has dropped when compared to the debt or the borrowings of the company. Tata Elxsi is trading at around 8.58 times and persistent at around 3.6 times. Tata Elxsi's profits have been growing at 20% compounded over the last 5 years, and profits have been compounding at 14%. Sales have been compounding at 13% and over last 5 years, and 9% over last 3 years. Persistent has seen a low profit growth rate over both 5 and 3 years at just around 3% or so, whereas revenues are growing at a healthy 13% and 7%. And that is why also we see why this company Tata Elxsi is getting a high premium in terms of net worth to market cap. We don't have the values of profits for 8K because it has suffered losses in the March 2020 quarter, and therefore you cannot calculate a value for that growth rate when it is in when the base year is in when the current year is in negative. Sales have been dropping at around 10% from 3 years back, and revenue has increased from 5 years back by around 25%. Anything more than 20% needs to be investigated by looking at individual values. Return on equity latest is around 25%, and on an average it was earning around 33% in last 5 years. So it has definitely fallen below its averages of both 5 and 3 years. Even persistent has seen a drop in its recent ROE of the recent 12 months to 13.9% from where it was in last 5 and 3 years on average. 8K miles had a negative value loss in 2020, therefore ROE would also be negative, but long term if we see it has been generating around 24 and 18% on a long term basis. And generally when we invest, we are always investing for more than 1 or 2 years, so we also have to look at long term values rather than just 1 year values. ROCE also is very efficient for Tata Elxsi at 34%. 5 years value is 49% and 3 years value is 45%. So again below its average, but quite a high values in terms of generating returns or EBIT on the capital employed. Persistent system also generating more than 15% of ROCE for both 5 and 3 years. 8K miles also was generating a good return of 30% and 22% over the last 5 and 3 years, but in the recent 12 months it has turned negative. Return on assets would be high for all of these companies because they have very less assets, and therefore the returns in in front of that is very high, so the return percentage would also be very high. So we'll ignore this particular ratio here. But if you have to just check out, you can see both of these are in positive and above 15%. We'll ignore the asset and inventory turnover. This company is into service industry, so we'll ignore this. Profit after tax of last 5 years for Tata Elxsi is around 1100 crores, and Persistent has generated around 1500 crores. 8K Mile has generated around 415 crores, whereas cash against that is 933 crores for Tata Elxsi, 1700 crores for Persistent, and 486 for 8K Mile. So all of these companies are generating cash against the profit declared, although Tata Elxsi has generated little less cash over the last 5 years, but not that substantial, also very nearby to the profits earned. In terms of free cash flows, it still has a substantial portion of the cash earned as free cash. Persistent System has 1655 crores of free cash, and 8K Mile also has around 210 crores. So almost lowest in terms of all these three companies. 50% drop in terms of cash generation against, rather 50% only left as free cash against the cash generated. On an average, 8K Mile is earning 83 crores every year, Persistent 305 crores, and Tata Elxsi 223 crores. Market cap to net worth, we earlier saw book price to book ratio, which was very expensive for Tata Elxsi at around 8 times. Persistent System at again 3 or 4 times, and 8K Miles net worth has dropped quite substantially to 25 crores, and the market cap is still huge at 261. So this market cap will need to come down to balance with the net worth, or the net worth will need to increase to come back to have a balance with the market cap, either of the two ways. But generally market cap would fall to equalize with the net worth. None of these companies have any substantial contingent liability. As I was earlier saying, that 8K Miles debt to equity has suddenly shot up to 5.3 times. That does not mean that they have taken up debt, it just means that their equity or net worth has been written off to quite a substantial value, and therefore when compared to the debt, now the debt is more than the equity portion in the business, and that is the problem with this company. Persistent and Tata Elxsi both are almost debt free companies. The coverages are also very high for the recent 12 months, whereas 8K's coverage has dropped to just 1.6 times its EBIT. Promoter holding is low for all three companies, below 50%. Highest is for Tata Elxsi at 44%. None of these companies have pledged their shareholding except 8K at 14%. Even though their promoter holding is very less at 38%, it becomes risky when it goes about 20%. That is, pledge goes about 20%. Debtors to sales is 21%. Highest collection to be taken against this year's sales is by Tata Elxsi, although within my benchmark of 30%. 15% to be collected by Persistent System from its customers, and 10% by 8K Miles. So the lower the better. As also, Tata Elxsi is taking 88 days to collect payment from their customers, which shows inefficiency in a way, but till it is below 90 days it is good, or 3 months it is good. Persistent System is taking around 60 days, and 8K Miles at around 48 days. Net profit margin is highest for Tata Elxsi at 16% in March 2020. Persistent is earning around 9.23%, and 8K Mile had a loss of around 13.6% in March 20. None of these companies are paying substantial dividend except for Tata Elxsi at just 1%. That too is not that substantial, although their dividend payout policy was quite good at about 30% or so. So this concludes my analysis of Tata Elxsi with Persistent Systems and 8K Mile Softwares. If you want to learn from me, you can contact me on my email address, and we will coordinate from there on. If you like this video, do share and subscribe with your friends. Thank you for watching this video.